Good afternoon, everyone, and welcome to today's webinar called Maximising Your Shared Cost AVC. If I introduce myself to you, first of all, as you will guess from the screen, my name's Stephen Black. I have 20 years experience working with the local government pension scheme, most of that time spent with Prudential, but I now work for a company called AVC Wise, and it's AVC Wise that's been appointed by your respective employers to administer an employee benefit called a salary sacrifice shared cost additional voluntary contribution, or shared cost AVCs for short. Horrible terminology, I know, but we'll recap on that a little bit later. Okay, so let's get going. What are we going to talk about? Well, we'll talk about how you can maximise your shared cost AVC and the benefits of doing that whilst paying in, but also when you retire. Now, I'm going to work in the assumption that you have a reasonable understanding of how your local government pension scheme benefits are calculated. If you don't, or you're maybe unsure of some of the terminology that I'm using, you might find it useful to also attend one of our other webinars called Understanding the Local Government Pension Scheme. Usual house rules from me: the information contained in the webinar, it's factual information only. It's not financial advice. You should always consider your own circumstances, and if you're in any doubt, we would encourage you to see a financial advisor for individual financial advice. So the session's broken down into three main areas over the next half hour. We'll talk about what's unique about the AVC in local government, so we'll recap on that. We'll introduce you to Joe. He's our case study for today, and then at the end we'll show you how you go about amending the amount that you pay into your shared cost AVC. But before we look at any of that, I'm going to take you back a few years when the government introduced their pension reforms. And what they were trying to do was simplify all the different pension rules on one hand, and on the other hand, encourage people to save more for retirement, because generally speaking, we don't save enough, but on average, we're living longer. And the government then changed the rules, and the encouragement to save more was that we would be allowed to take more out as a tax-free lump sum. So whichever pension scheme you belong to in the UK now, you're allowed to take up to 25% of the benefits out as a tax-free lump sum, which was much greater than what was allowed under the old rules. Now, there'll be some of you on the call today who have got service in the old 80th local government pension scheme. So if you remember, that was the local government scheme that ran until the 31st of March 2008. So if you've any service in that old 80th scheme, the scheme that ran to the 31st of March 2008, you get an automatic tax-free lump sum in respect of that service. But any service that anyone's earned from the 1st of April 2008 onwards, there's no automatic tax-free lump sum from that service. Now, even for the service that those of you who have got years in the 80th scheme gives you, you get an automatic tax-free lump sum. It comes nowhere near this 25% limit that you're allowed to have. So how do you get more of a tax-free lump sum? Well, you've got two ways of doing that in local government. And the first way, what you can choose to do is when you get to retirement, you can start to reduce your annual index-linked pension. So you can bring down your pension on one hand. In exchange for reducing your pension on one hand, it means your tax-free lump sum on the other hand goes up until you reach your 25% limit. And that works in a ratio of 1 to 12 called the commutation rate. So let's imagine you're retiring today at 60. You could choose to say, well, look, I'll reduce my annual pension by £1,000 a year. And in exchange for doing that, it means you increase your tax-free lump sum by 12,000. But let's think about that for a wee second. Let's imagine you do want to retire at 60. You're expected to live until your mid-80s. So if you were giving up £1,000 of annual pension to increase your lump sum by 12,000, that would be 1,000 of pension you'd be giving up this year, next year, every year throughout your retirement, which was going up in line with inflation. And the pensioners in your scheme, they've seen their local government pension go up by around 20% in the last 10 years alone, never mind, say, 20 odd years that you might be alive when you retire. So giving up pension for lump sum at a rate of 1 to 12 is actually a really poor exchange, unless you could guarantee that you would die early in retirement. which case then you'd say, give me the bigger tax-free lump sum, because I'm not going to be around to collect the pension for that long. Okay, so wouldn't it be nice to have both, get a bigger tax-free lump sum, but without you having to reduce your index-linked pension to do it? Well, there's a way in which you can do that in the local government pension scheme, because when the rules changed a number of years ago, local government allowed, a change they made was allowing you to use the additional voluntary contribution part of your scheme as the vehicle to give yourself a bigger tax-free lump sum, so that you'd be getting more tax-free, but without having to reduce your index-linked pension to do it. So essentially, the best of both worlds. You can use the AVC part of your scheme to give you this bigger tax-free lump sum. So you're getting more tax-free, but not reducing your pension to do it. Now, hopefully you all pay AVCs. Those of you in this call, you pay AVCs already. So hopefully you knew that. You've got this ability to take your AVC as a tax-free lump sum. I describe that as a huge deal, because local government, you're the only public sector scheme that allows that to happen. If you're police, fire, civil service, NHS, MOD, judiciary, they can pay AVCs, but they can only get a quarter tax-free. Your local government, you can get the whole lot back tax-free. That is a huge deal. Two caveats to that are, one, taking your AVC as a tax-free lump sum means taking it at the same time as you retire with your main scheme benefits, whenever that is. And two, there's ultimately a limit, and we'll look at that limit just shortly. But you all know now, if you never knew before, and I'm sure you did, up to a limit, when you retire with your main scheme benefits, you can take the whole AVC as a tax-free lump sum. Now, you don't have to do that if you don't want to. You still retain the flexibility. If you want to use your AVC to buy a pension, you can do that when you retire. For example, you can buy an annuity from an insurance company. And obviously, one of the main advantages of putting money into AVCs on the assumption that you're a taxpayer is you get tax relief on your contributions. So if you're a basic rate taxpayer, you pay tax at 20%, which means you get 20% tax relief on your AVC contributions. If you're a higher rate taxpayer, you pay tax at 40%, so you get 40% tax relief on your AVC contributions. Obviously, a huge incentive to save for retirement because you get tax relief on your contributions. Now, there are two things unique about the local government AVC. One is this ability up to limit to take it all tax-free when you retire with your main scheme benefits. And the second thing links into the second title in this slide. You all work for employers who have set up the local government AVC on a shared cost basis via salary sacrifice. What on earth does that mean? Well, in simple terms, what it means is on top of getting tax relief, you're also able to save in national insurance as well. So the basic rate taxpayer who pays tax at 20% and gets 20% tax relief, they also save in national insurance at 12%. The higher rate taxpayer gets tax relief at 40% and saves national insurance at 2%. So again, additional incentive to save for retirement. And that also, this ability to set up the AVC in this shared cost basis via salary sacrifice, local government, you're the only public sector scheme that allows that too, so which is absolutely brilliant for you. Having said all of that, an employer in local government has to choose to set up the AVC on a shared cost basis. That's what your employers have done for you, which is brilliant for you, because there are so many local government employers out there who just haven't done this for their staff. You all work for employers who have, which is great news for you. Okay, so let's get to grips with the terminology. So this is Joe. Joe earns 30,000 a year in local government, and the first column assumes he doesn't pay AVCs. So he earns 2,500 a month, pays his standard local government contribution of 162.50, standard tax of 259, standard national insurance of 205, and he's left with a net pay of 1,873. And it's at the end of this slide that I'll stop for the first time and invite James in to pick up any questions. So Joe here works for an employer who has set up his local government AVC on this shared cost basis via salary sacrifice. So the first thing he wants to do is get to grips with the terminology. Now, shared cost AVC is one where both you as the employee and your employer, you both contribute, you share in the cost. Your share in that cost is always £1 per month. The balance treated as the employer's contribution. So Joe here, if he's wanting to save £250 a month, £1 is treated as his money, the other £249 is treated as his employer's. But of course, your employer isn't just going to put money into your AVC out the goodness of their heart. What they get you to do is sacrifice the equivalent amount from your monthly pay. So you'll notice Joe's pay comes down from 2,500 to 2,251. His salary comes down by £249 a month. And that's what the employer takes. They take that reduction of 249 plus Joe's £1 and puts the full 250 into his AVC. Now, the most common question I get asked at this stage, is that not a bad idea? If I'm reducing my salary at the top end, will that not have an impact on my main local government benefits? And the answer to that is no, it doesn't. It would defeat the purposes of doing this if there was to be any detriment to your main local government benefits. And you'll notice in the second column, Joe continues to pay £162.50 to his local government scheme, because his local government pension scheme, the benefits he builds up are always based on the original salary, the pre-sacrifice salary of £2,500 a month, which is called notional salary. So he's putting his 250 in. He's a basic rate taxpayer, so he's entitled to basic rate tax relief. So if he pays tax at 20%, 20% tax relief is what he'll get on his AVC contribution. So £250 a month going in, 20% tax relief is £50. So you'll notice Joe's income tax comes down by £50. He's saved himself £50 in tax. You'll also notice his national insurance has come down from 205 to 175, and that's because for the purposes of calculating national insurance, it is the reduced salary of 2251 that can be used to calculate Joe's national insurance. So for Joe to save £250 a month into his AVC, it actually only costs him £170.12 out of his take-home pay. You'll see his take-home pay in the first column was £1,873. Now it's £1,703. So he's saving £250 a month. It's cost him £170.12 from his net pay to do that, because he saves £50 in tax and £29.88 in national insurance. And just think about this for a wee second. If you were saving £170.12 in your bank, building society, credit union, ISA, whatever, to turn £170.12 into 250 is about 47% of an increase. Okay, which is a huge amount. Clearly in the bank or building society or ISA, you can go back tomorrow or today and get the money back out. That's your hurdle with AVCs. But as you're heading towards retirement, this is when you're more likely to put in more to your AVC, because you're waiting less and less time before you're due to get the money back. So I hope that makes sense. So I'll pause there. I'll invite James in to pick up any questions that have come through so far.
Hi, Steve. No questions so far.
Okay, I nearly choked on my coffee there. I was expecting some questions, but that's fine. So we'll crack on and we'll continue the theme with Joe. So we're going to assume Joe, when he's retiring, is on target to receive an annual pension from local government of £15,000 a year and a one-off tax-free lump sum of £10,000. So that tells me that Joe has got some service in that old 80th scheme, the scheme that ran to the 31st of March 2008. So what Joe's interested in doing is he wants to increase his tax-free lump sum for his retirement, but not at the expense of his local government pension. He wants to keep his £15,000 a year. He doesn't want to reduce that at the rate of 1 to 12. So he gets what's known as standard benefits, £15,000 a year pension and a £10,000 tax-free lump sum. So Joe's looking at paying AVCs then to give him a bigger tax-free lump sum, and he knows, and this is the wording typically you'll see in your local government website, he knows that I can take my whole AVC as a tax-free lump sum when I'm retiring and taking my main scheme benefits at the same time. But he knows too that the total lump sum he takes can't be more than 25% of the total value of his local government benefits. And that includes any lump sum, in his case, his 10,000 one-off tax-free lump sum. So this is the bit that some members sometimes find confusing. What is my limit? I know I can't get more than 25% of my benefits tax-free. What is that limit? Well, we'll look at it for Joe and we'll clarify it. So for him, if he's getting a standard pension of 15,000 a year and a one-off tax-free lump sum of 10,000, then it means it's anywhere up to 90,000 for him in his AVC. Up to that level, he can take the whole lot back as a tax-free lump sum when he retires with his main scheme benefits. How do we work that out? Well, I'll explain it here. I'll explain the science, but it's one of the things you might check with us after today if you're interested to find out what is your limit. So the first thing I need to do is work out what's the value of Joe's benefits for him to get a quarter tax-free. And how we work out the value of your local government pension scheme benefits is we look at the value of your pension, in this case 15,000 a year, and multiply it by 20. Why do we multiply it by 20? Well, that's the government actuarial department valuation figure attached to your local government scheme. So you multiply your pension by 20, so 20 times 15,000 is 300,000. You add on the tax-free lump sum of 10, and his local government benefits are worth 310,000. Okay, pretty straightforward so far. If he had £90,000 in his AVC, then his local government benefits wouldn't be worth 310,000 any longer, because if he had 90,000 in his AVC, then his local government benefits would now be worth 400,000. So the 310 plus the 90 is 400,000. You can get a quarter of your benefits tax-free, so a quarter of 400,000 is 100,000. So that would be his maximum tax-free lump sum, 100,000. And where could he take that from? Well, he would get that from the 10,000 that he's already getting automatically and the 90,000 that's in his AVC. So that's his optimal limit. Anywhere up to 90,000 in his AVC, he could then get back as a tax-free lump sum on top of the 10,000 lump sum he's getting already and the 15,000 a year standard pension. But as I say, I'll explain just shortly how you can go about getting your calculation done. What's the limit you can have in your AVC as a tax-free lump sum? We can work that out for you. Now, moving on and starting to head towards the end here, this session, it's people 55 and over who have been invited to this session, which should mean that for some of you, you're getting closer and closer to retirement. And this is when you're most likely to now start trying to ramp up your AVC contributions to try and build up the maximum possible tax-free lump sum that's available. And this just shows you the impact. We've already looked at Joe paying £250 a month. Remember, he was saving £50 in tax and £29.88 in national insurance. In the right-hand column, if he seriously increases his AVC to £1,000 per month, then of course he's going to save even more tax and he's going to save even more national insurance. So if you were putting £1,000 into your AVC a month, it would only cost you £680.12 to do that. On £1,000 a month going in at 20% tax relief, you'd be saving exactly £200 in tax and £119.88 in national insurance. So that combination of income tax saving and national insurance savings is almost £320 a month. That's what Joe would be saving, whereas at the moment, without an AVC, that's what he would be given to the taxman or HMRC, the government. That's what he'd be giving them every single month, not for his benefit. Whereas putting 1,000 into the AVC, that 200 income tax saving and 119.88 national insurance is for his benefit. So I hope that makes sense. What I'm going to encourage you to do after today is go and look at a payslip, look at what you still pay in tax and national insurance. That's the really sobering part. and you'll see, right, okay, you've still got potentially a lot of tax and national insurance still to save for your own benefit, for your retirement. Okay, and this is where you maybe are. If we look towards the right-hand side of this slide, this is where typically people in local government, once they get to 55 and over, start to try and increase their AVC contributions for two reasons. One, once you get to 55 or over, maybe the mortgage is paid off, maybe the kids are up and off your hands, or you're certainly heading that way. But the bigger reason for trying to put more in as retirement gets closer, quite simply, is you're not then waiting that long before you're due to get the money back. And I'm sure those of you in the call today will know colleagues, or at the very least you've heard stories of colleagues who close to retirement were maybe putting in thousands of pounds per month into AVCs in the run up to retirement. That's a really common thing in local government if you can afford to do it. Okay, so you know this now, taking your AVC at the same time as you take your main scheme benefits, then from the age of 55 up to your limit, you can get the whole damn lot back as a tax-free lump sum. That's a huge deal for you in local government. You don't have to do that if you don't want to. You could take part of it tax-free and use the remainder to buy an annuity. You can still do that. You could take part of it tax-free and use the remainder to buy more index-linked pension from your local government pension scheme. You could do that too if you really wanted to, or a combination. You'll see I've got a little website down in the bottom left-hand corner. Pension-wise, they have no relation to AVC-wise, but Pension-wise is a government-led body where you can get guidance on your retirement options. That's an impartial service available to you from the age of 50. Not really for the local government pension scheme benefits, but maybe if you've got pensions there from previous employment, old private pensions, then they can maybe help you with your options with those. Now, supposing you want to or need access to your AVC before taking your main scheme benefit, you can do this, but the tax treatment isn't as generous. It's not as advantageous. If you're interested in that, then maybe come along to some of our other webinars where we go into that in a bit more depth. Okay, consider conditions and considerations for shared cost AVC. So the first thing, remember, whatever you put into your shared cost AVC doesn't affect your main local government benefits when you retire. Your employer will not allow you to contribute so much to your shared cost AVC that it reduced your salary below national minimum wage, which for most of you, if not all of you, is £8.72 an hour. Neither would you want to put so much into a shared cost AVC to reduce your salary below the lower earnings limit. If you reduced your salary below the lower earnings limit, which is a limit of £6,240 a year, bringing your salary below that could affect your state pension, which again would defeat the purposes of doing this. 3 government limits to mention. Annual allowance, there's a limit as to how much you can contribute to each year to pensions and receive tax relief. It's £40,000 a year, although someone could put in more than that, £40,000 a year potentially if they've got unused allowance from previous years. And just by being a member of the local government pension scheme, you use up part of that £40,000 a year limit. There's also something called money purchase annual allowance. I don't know if this applies to any of you, but if you are 55 or over and you've accessed old private pensions in the last 5 years under the government pension freedom legislation, then that maybe restricts what you can put to your AVC to just £4,000 a year. There's also something called lifetime allowance, and again, some of you will remember the days when you could build up a maximum of 40 years in local government at the age of 60 or 45 years to 65. Those limits are long gone. It's now the value of your benefits that are important, and you're allowed to build up benefits in this tax year to the value of £1,073,100. Going over that means you could be facing a tax charge, but as you can imagine, very few members would be affected by that limit. Your shared cost AVC, hopefully you know you can change the contribution whenever you want. You can stop your AVC, and of course it would need to stop if you left your employer. So how do you go about amending your AVC after today? Well, you would just go to the AVCwise website, avcwise.co.uk. You would go into your record and put in the new amount that you would want to contribute. So once you've done that, your employer verifies your application. So for example, they'll check that you're not putting in so much that it reduced your salary to below the national minimum wage. Now, I've showed you an example today of Joe who was paying nothing, paying $250 a month to £1,000 per month. But of course, you can change the amount to whatever you want, although clearly the more you can put in, then the more tax and national insurance you will save. And once you've amended your AVC and your employer has verified your application, you pay your new amount from your next available salary. All pretty straightforward. Now, changing your AVC amount online is by far the quickest and easiest way to do it. But we're also conscious when people get to increasing their contribution and they're maybe getting closer to retirement and they're maybe thinking of putting in bigger and bigger amounts, then maybe it's helpful to have the reassurance to talk to someone to do that. We can offer you that. We can have a 20-minute meeting with you on a one-to-one basis. We do need you to do some preparation for that. So having a local government projection of your benefits to your desired retirement age, you would need to get that, which you've maybe got access to that online through your local government pension scheme. You all pay AVCs already, so if you can get an up-to-date valuation of what your AVC is worth, your AVC will be with either Prudential or Standard Life, so you can get an up-to-date valuation of your AVC benefits and have a recent pay slip available, and consider how much is it that you're looking to give up out of your net pay to your AVC. And if you've done that preparation, that allows us to work out what can you have in your AVC as a tax-free lump sum when you retire with your main scheme benefits. And we can also work out, right, what is the maximum amount you can give up out of your monthly pay to maximise your tax and national insurance. Okay, we're not financial advisors though. We're not here to give you advice on investments, but we can help guide you along the way to helping you make the right decision for yourself. Okay, so in summary, you might be heading towards retirement. This is when people are most likely to try and pay in more to maximise their AVC before they retire. Increasing your contributions now could have a substantial impact on your final benefits. Even if you're getting really close to retirement, you maybe think about ramping up your AVC contributions over a real short term. That's a really common thing. Even if you've got, say, 3 months to go before you're due to retire, you might look at increasing your contributions. I am Scottish, you've probably noticed. If there's a better way of saving money for retirement, then I'm being absolutely sincere when I say this. I don't know about it. What you've got in local government is fantastic, and the fact that you work for employers who have set up your AVC in this shared cost basis to allow you to save national insurance on top of the tax is absolutely brilliant for you. Okay, what's next after today? Well, I mentioned we have developed a suite of webinars. So you're in the, the fifth one down, maximising your shared cost AVC, but we have got another, quite a few other webinars. You can go to the AVC-Wise website, and in the presentation section, you'll see what presentations we're running and when, in the kind of brief summary of the content. My final slide, and I'll invite James in at the end. But if you do have any questions, or if you want to request a one-to-one meeting with us, just email us at support@avcwise.co.uk. We've got a live chat facility. You can phone us. We've got a knowledge hub where there's some short explainer videos which you might find useful. When you go into the AVC-Wise website, you go in via your employer portal, and that gives you access to your employer's terms and conditions and frequently asked questions document 2. And if you've got any questions on your main scheme, local government benefits, you'll see there's the lgpsmember.org website too. So before I bring things to a close, I'll just invite James back in. James.
Hello, Stephen. We have a couple of questions. So from Judith, can I check when I request to pay more AVCs? AVC-Wise will have done the calculations that I don't go below the lower earnings limit and national living wage limits. So what you're more than able to do and welcome to do is contact us via email, support@avcwise, or give us a call on that telephone number. what we can do is with your salary, we can run the calculations to work out what the most you can pay into your shared cost AVC in order to make sure that you are satisfying national minimum wage, lower earning limit requirements. So we can do that calculation for you. Just give us a call with your payslip so we know exactly what your salary is. Okay, and we can do that calculation there. Second question from Judith: if I pay more, but the tax relief is higher than the tax I would normally pay that month, how does that work? So really important to note that you'll only receive tax relief at your marginal rate. Okay, so what we mean by that is you'll pay tax. You'll get the tax relief at the rate in which you pay tax. But again, what you're more than welcome to do is give us a call, drop us an email, and depending on what your payslip is, we can have a look at that for you and give you an idea of what your taxable income is. That's all of the questions at this time, Stephen.
Okay, thank you, Matthew. James turned into Matthew there by the end, so you've had three of us today talking to you. So I hope that all makes sense. As I say, if I can encourage you to do one thing, go and look at a payslip, look at how much you're paying in tax and national insurance, and even if you can increase your AVC only by a little bit, then every little helps, I guess. So thank you for dialing in. No more from me, and live long and prosper. Thank you.